So today we're going to learn about share buybacks, why companies buy back their own shares, and how this billion-dollar financial moves make shareholders richer without even paying them a single penny. Right? So why would a company buy something that it already owns? Right? So, to understand that, we have to first understand the company's cash dilemma. Right? If you're talking about a company who is doing good in their business, both on paper as well as a good reputation in the market, it is bound to have a problem of generating more cash than it can productively reinvest. Right? When all the factories needed are built, customers are acquired, and all the growth opportunities are funded, what should the management do with the excess cash? Right? So basically, companies like Apple have managed to return more than $700 billion in to shareholders in form of share buybacks, and the greatest CEOs often choose to buy their own stock instead of building new factories. But again, at a certain level of that they have achieved, they can do that. If they have an opportunity in which they can invest that excess cash generated, they should definitely go with that. Right? So what should a company do when it has more cash than it knows how to use? Right? What they can do is they can pay dividends directly to the shareholders. They maybe can build a new factory or acquire another company, or they can buy back their own stocks. Right? So before understanding buybacks, we must understand what basically a share represents. Right? Share is nothing else but a ownership. A company is like a pizza cut into slices. If the company has, let's say, 10 outstanding shares, and you are able to own one share of that company, you basically own 10% of the company. Right? This means 10% of the profits belong to you, 10% of the assets belong to you, and 10% of the future growth belongs to you. You are the owner of the company, right? This concept of fractional ownership is the entire foundation of stock buybacks, right? So let's get to the mathematics side of that, right? What it does is basically it is able to increase the EPS number, which is earnings per share. Let's say your total profit of the year is 1000 rupees and 100 outstanding shares. Your EPS is 10 rupees. Earnings per share is 10 rupees. This is the formula, right? Now, with the same profit, the unchanged profit of 1000 rupees, but you bought back 20 shares and now you are left with 80 outstanding shares. With the same profit, you have achieved a much greater EPS, right? Earnings per share increased by 25% from 10 to 12.5 without company earning a single more rupees. This remains equal. This is what changes, right? So when we are doing comparative valuation, in order to find out what the stock price is, right, to find out the intrinsic value, we use this formula: EPS multiplied by price upon earnings per share. So basically what it does is, we have EPS here, we have price here, we have EPS here. So this gets cancelled out and we are left with the price. Now this is something that the company is earning. This is based on the fundamentals, right? This is based on the market reality of that particular company, right? So now, before buyback, the price of that particular company would be 200 rupees. The intrinsic value is 200 rupees. But because 20 shares were bought back, right? They were bought back, in PE has increased. No, right? What has increased? Only and only EPS has increased. right? So this comes to a price of 250, right? So if the market price is currently 215, investors would be willing to buy in this particular situation rather than this particular situation, because they are expecting a profit on their investment. If investors keep the same PE valuation multiple, the stock prices rises from 200 to 250, which is basically a 25% increase without any change in the business performance. This could be year 1, this could be year 2, but profit equal, because of buyback, EPS is has increased, and which leads to the increased value, right? So it's just a mathematical proof. This is how numbers get manipulated, right? So let's look at the micro, meso, and the macro level understanding of this topic. Let's say I own one share, right? My ownership after the buyback is bound to increase from 1% to 1.25%, because there are now less number of outstanding shares. The number of outstanding shares have reduced, so my ownership has increased in that particular company. Next year, let's say I have 1% ownership in the company, and let's say the profit is 100, so I get 1 rupees. I'm the owner of 1 rupees. I might not get, see, getting money from the company would be considered as a dividend, but you still own 1% of that profit, right? The next year the company might still get a profit of 100 rupees, but now I'm a 1.5% owner of that particular profit, right? So eventually I am getting more closer to have a concentrated share of that particular company in terms of ownership. Talking about the meso level understanding, across all the shareholders, ownership becomes concentrated. Fewer shares remaining means each share becomes more valuable. At the macro level, buybacks are one of the largest sources of stock demand. Companies demanding its own stocks, it is creating demand for its own stocks in the market. They are willing to buy at maybe equal or maybe higher market price, right? So companies are the biggest buyers of their own shares. Now comes the dark side. Obviously, everything is not always in a positive sense. Things go sideways, right? See, buybacks have known to destroy value for few reasons. First of all, problem number one, overpaying. Let's say, as per the fundamentals and the market behavior, the stock's intrinsic value comes out to be 100 rupees, but the current market price is 250 rupees. So essentially, for the existing shareholders, not for the shareholders who are willing to sell their stocks, for the shareholders who are actually sticking with the stock rather than selling them off, what happened? A stock worth 10 rupees is being bought for 250 rupees. So it is being bought at a premium, right? A stock whose value is only 100 rupees, company is ready to buy it at 250 rupees, that is paying premium over it, right? First of all, the company has to make sure that the premium is justified rather than the investment as a whole. Paying such a large amount is a difficult decision, right? So the company has destroyed the shareholder value, the shareholders' interest, right? If you are buying a stock whose intrinsic value is 100 and you are getting it for 90 rupees, that is something that shareholders would like. This would eventually increase the shareholders' value, right? Then there's a EPS manipulation. Management can artificially boost the EPS even when the actual business performance is flat. With the same profit, we were able to calculate the 25% increase in EPS, right? EPS rises, profit stays flat. Investors must learn to spot this trick. What is happening when companies are buying back? What are the reasons behind it? It is very important for the investors to be fully aware about it. In the previous video, I also just suggested that when you are investing or doing anything in life, it's not just restricted to investing. You should be knowledgeable about what you're doing. You should be disciplined enough to understand what is happening, why it's happening, and to make a smart or educated guess based on solid backing. Right? Now, this is the biggest problem. Right? Management buy back share for multiple reasons. Right? We don't know the particular ideology behind it. Right? The problem is, the red flag is when, if the company has enough profits, it's okay. But the problem arises when the buyback is debt funded. Right? Some companies borrow money to fund their buybacks. This increases financial risk and weakens the balance sheet as a whole, trading long term stability for a short term EPS boost. Now, try to understand why would company try to boost their EPS when such risk exists. See, what if the CEO's compensation is based on increase or growth in EPS? With the same profit, were we not able to have observe a increase in EPS? We were able to observe an increase in EPS when we had a share buyback, right? So what if this situation? But an undisciplined CEO would definitely drastically wrong. See, that although is a cheaper source of funding, but again, we are having a forced commitment to fulfill those interest obligations. This is a major problem in that. Right? Being leverage is a good thing unless and until you are using it to increase your efficiency, but doing such drastic moves just for the compensation or maybe bonuses, this could actually weaken the existing business of the company that can actually do good if the right things or the right times comes, right? But in those right times, those interest obligations would be a big headache to take care of, right? A buyback does not create value automatically, it redistributes ownership. The value created depends entirely on whether management is allocating capital intelligently. This is what a company's management should ideally be focused on, rather than just increasing and manipulating the EPS. Right? So, before going to the case study, I just want to make sure that you understand one thing. So, when we're talking about buybacks, so when the company buy back those shares, it does not tend to disappear in air, right? We have seen that what happens is number of outstanding shares in the market have reduced, but where does it actually go, right? So when a company buy back shares, rather than disappearing into thin air, they undergo a legal cancellation process called retirals, right? Or they could be held on company's balance sheet as a treasury stock. Either they could undergo a legal cancellation called retirals, or they could be held on company's balance sheet as treasury stock. Now let's see a good example of Apple on how they were able to increase shareholders value through buyback. Over the years, what Apple has done is spent or given shareholders more than 700 billion. This figure is actually now close to 850 billion. They have returned 850 billion dollars through buyback to shareholders, but over decade, not in a single transaction, but over a decade or so, right? What happened? Shares outstanding declined significantly, EPS amplified. See, the good thing about Apple was it was a growing company. It was increasingly doing good in terms of business, in terms of revenue, in terms of building a brand reputation, right? So rather than profits being constant, we have seen an upward trend, right? So 100 rupees profit upon 10 shares, this was the example that we were taking earlier. But in this case, what happened? This also increased and this also decreased, which eventually amplified the shareholder value. It amplified EPS as well, but it's also increased the shareholder value. The long term investors, the long term shareholders benefit from this enormously, right? Because both of them were doing actually good, right? So Apple generated enormous cash, far more than it could productively reinvest, right? They didn't want to over diversify their product portfolio. Rather than, what they did is something that proved to be ultimately very, very beneficial for the shareholders. Management began buying back massive quantities of stock. Over time, shares outstanding fell significantly, which basically amplified the EPS growth dramatically, because again, these two were moving in a favorable direction. Long term shareholders benefited enormously. Why it worked? Exceptional underlying business. This is the key lesson. If tomorrow there is a news that this particular company is buying back its shares, what question you have to ask? You have to go through their statements, the news, the market reaction about that particular company before, or their order book maybe, right? What are the future projects? What and towards which direction they are heading? You have to make sure that it is not a manipulation trick, but rather a significant decision made for the welfare of the shareholder. It worked because it generated enormous cash, and they were successfully able to do a reasonable capital allocation. The buyback complemented genuine business performance, right? It was not a trick but a smart move. They didn't replace it, right? Now, again, if you are eventually giving back money to existing shareholders and concentrating the existing or the long term shareholders value, you could actually give them dividend in a form of something that they can use daily. In dividends you get actual cash in hand, right? You are basically able to use that money for whatever you want to do, right? It's not a question of reinvestment at all, because buybacks should genuinely come when all the reinvestment opportunities are not as good as buyback or dividends, right? So what will happen? The 1,000 rupees profit and 100 number of outstanding shares, you will get a, let's say with the 0% retention ratio, you get 10 rupees each. Investors do get cash immediately. They are direct and tangible benefit. You can actually see that value in your hand, in your bank account. You can easily liquidate that position, right? But the most important thing, dividends are taxable income, right? So value of share or the capital appreciation, right, could only be taxable once they are sold. When you actually realize their value, when you actually liquidate it, not until then they are not under any tax liability. It doesn't matter if you still hold a share that was 10 rupees worth when you held it and now it's worth maybe 10 lakh rupees. You're not taxable unless and until you sell your position. Companies hate cutting dividends later. Having enormous cash in hand in one particular year could be a result of anything. it could be a one time realized gain, or anything. It could be anything, right? But let's say company is breaking the market by announcing that they are giving 10,000 rupees. This is an enormous figure. This is not at all what you see in everyday life. Let's reduce it, right? Let's say company is saying we're giving 100 rupees. This is enormous as well, but let's completely go with that. The next year, what happened? Company doesn't have the same amount of money as they had in the previous year. They're barely making profits and they don't even want to give dividends, let's say this year, right? So one year they are breaking the market, the next year maybe they are willing to give 5 rupees as dividend, because that's what their balance sheet or income statement can possibly withhold, right? A 5 rupees dividend could be logical with respect to that particular year income statement, right? So this drastic reaction would definitely stock and could be a red flag in the company, right? So with this, the management gets very less flexibility, right? Management are just simply giving out money and nothing else is happening. Just maybe on a fundamental sheet the dividend yield number is being boosted for some particular reason, right? But what happens in a buyback approach? Buy, you basically are giving liquidation, you are creating demand for people who want to exit their position, plus the existing long term shareholders are getting a concentrated ownership rights, right? Investors benefit through greater ownership percentage. They are often better tax treatment. Of course, tax is, you are liable to give tax only and only when you liquidate your position, right? In the, that too in the, if you're holding for more than 1 year, that too in the long term capital gain, in which you get an exemption, right? More flexible for management, right? Benefit is indirect. You are not getting physical value in hand, physical money in hand, a number reflecting in your bank account, just an increase in ownership. Again, comes to the example, it can destroy value if overpriced, right? In the particular example that I talked about here, you are doing bad for the shareholders in this particular situation, right? A small difference makes sense, right? But such a big difference would actually be very harsh for the shareholder value. Now, neither of these approach is universally superior. The correct choice always depends on the situation, the tax implication, the value of shareholders, what are the growth opportunities that you are going or you are having. So basically, let's say the company is giving 100 rupees of dividend, right? But giving 100 rupees dividend to one particular person and everyone, all that money could actually be used somewhere else to reinvest, right? You won't be, see, the move by the company to give money back to shareholders when they could ideally invest in a, maybe acquiring a company, maybe building a new factory or anything else. That is a particular situation in which reinvestment is must, right? Reinvesting rather than buybacking or maybe giving dividends, this comes secondary. First is the reinvestment, because the gains that you will get from dividends are, first of all, tax liability increases. The capital appreciation is much more exponential when the company is able to reinvest its cash, right? It's beneficial for you as well, right? Because you get a dividend of 25 rupees, you won't be able to reinvest this particular 25 rupees in anything good. You won't even think of, maybe as simple as that, opening an FD account out of it, right? You won't open an FD of 25 rupees and get 25 or 25.5 rupees after 5 years. This is not what you want, right? You don't have much better obligations or opportunities to use this $25 as the company has. The company has much better opportunities, right? So when and in what circumstances buybacks make sense? When management actually have access cash, you don't have to figure out and go towards and think about debt. When shares are undervalued, the intrinsic value could be 100 and the market value could be 90. Ideal situation, you should do that. This is good for shareholders. When you have no better investment opportunities in your hand, right? Those 25 rupees as dividend would do nothing for the shareholder. He would be recklessly spending in places he doesn't even want to, and the company as a whole has could have better opportunities if available, should prioritize reinvestment at any cost. Strong underlying business performance. You have to understand about your business. You are the best person who knows about your business management, right? So you should understand what and where the business performance is heading towards, right? If you can use that particular cash in reinvesting on existing operation, or maybe opening another parallel side business, or maybe anything, right? So you should as a company go for that when it complements genuine growth. When buybacks actually destroy value, when the shares are overpriced, when it is funded by debt, lots of obligations, when it is used to mask poor performance, when management is artificially boosting EPS, and when better investment opportunity exists. The real question is not whether a company buy back stock, it's whether it's buying back stock for the right reasons and at the right price. Thank you so much.